Today we are going to talk about tax treaties and their role in international taxation. Imagine you are the manager of a corporation that is ready to expand business abroad through direct investment. You consider two very similar countries as potential investment locations. However, only one of them has concluded a tax treaty with your corporation's residence country. Now you wonder what a tax treaty is, and whether it should affect your investment decision. A tax treaty is an agreement between two or more countries to allocate taxing rights and thereby avoid international double taxation. A tax treaty specifies whether the profits your corporation earns from the foreign direct investment are taxed in the source, or residence country, and to what extent the other country must forego its taxing right. In general, tax treaties require contracting countries to agree upon a method to avoid international double taxation, such as the exemption or credit method, depending on the type of transaction. A treaty can also outline conditions for withholding tax reductions. Effectively, a tax treaty specifies whether the worldwide or territoriality principle takes precedence when allocating taxing rights between the contracting countries. Besides, tax treaties establish common definitions for specific legal concepts, such as a permanent establishment. Only if a common understanding of such terms is established, taxpayers can be sure that their actions are treated consistently for tax purposes in both countries. Thus, international double taxation resulting from divergent understandings can be avoided. Usually, tax treaties are not drafted from scratch. They are instead based on tax treaty models like the OECD Model Convention or the UN Model Convention. Contracting parties can use these models as a general guideline when negotiating their own treaties. But what if a specific scenario is not covered by the tax treaty and an international tax dispute arises? In this case, the tax treaty contains provisions for resolving these disputes. In general, mutual agreement procedure and arbitrage are proposed as resolutions in a tax treaty. As a manager of the corporation, you now know that it is favorable to invest in the country which has signed a tax treaty with your corporation's residence country. To summarize, countries use tax treaties to reduce or avoid international double taxation. A tax treaty, in general, allocates the taxing rights between the residence and the source country. It also establishes common definitions of legal terms and provides a mechanism for dispute resolution.